Hey guys, this is Jason with Monthly Trading Systems, and today I'm going to talk to you about how to trade options, the call spread strategy. And the call spread strategy is under my post categories under Options 101. The call spread option strategy is employed when the option trader thinks that the price of the underlying asset will go down or moderately neutral in the near term. It's pretty simple to place these orders. All you got to do is buy one out of the money call and sell one out of the money call. Now you don't have to do one, you can do as many contracts as you want, but they're usually equal. Same amount of equal under the same expiration date. So you could do this underneath a stock or an ETF where you buy a call and you sell a call, and this is where the live stock price is. So in this particular example, the stock's at 150 and it's live, and it's been going up and down, but that's the highest it's been in the past. And so what you go is you go out of the money up here and buy and sell a call option to take in a profit, which sometimes is called a debit spread because you're taking in money automatically. There is limited upside risk and there's limited downside risk, and a lot of times you will have to do an adjustment, or sometimes you'll have to do adjustments, not a lot of times. And let me go over to Thinkorswim right now and kind of show you what it looks like within the trading platform. Okay, now I'm in Thinkorswim. I'm actually in the Analyze tab. I'll look at the Monitor tab, I'll look at the Analyze tab, and the Chart tabs here. I've already have an order on. It's been on for about maybe 2 weeks now. And really what an Analyze tab will teach you is how to look at your chart graphically. And if you looked at the previous chart I was showing to you in my blog, the debit spread, the buy the call and sell the call, and I scroll back to here, this is the same thing. This looks very similar, right? This is your profit and loss right here, and right now if you look right here, I'll be making $64 with the risk of $436, which is actually about $500 worth of risk. You may ask yourself, well, that's not a very good return on your money, but it all depends on your strategy and what your plan is. So anyway, what I've done is I went ahead and added these strike prices here and moved them over to my chart. So let me go over to my chart and show you what this is. So this is the spiders. This is where the actual close of the stock was as on Friday of last week, and it's getting up to the point where I'm getting to where I would like to do an adjustment. This is my actual spread right here. This is where I bought the call and sold the call, and that is my spread. It's a 5-point spread. Right here is where the stock is, and if this closes above this red line, I will make an adjustment later this week and roll my stock. I'll roll these spreads up or even to the next month to minimize my risk. But my goal is for this, and what I think is going to happen here with this stock is it may go up a little bit more, but it's going to fall back down and stay within this range, or actually keep underneath this range here. So if you notice something here, the actual volume on Friday was relatively low, and you had a pretty high candlestick there. That means that you had a lot of growth or a lot of pull up in the market with very little volume. That sometimes is a signal that says we could see a pullback in the market a little bit. I'm not saying that you're going to see a huge drop or the market's going to crash, but I'm saying it could pull back a little bit, and my projections it's going to stay within this range for a little while. Okay, I actually, in my monitor tab here, I actually going ahead and put a buy the spread back at 2 cents. So right now it's at 85 cents or 80 cents, and whenever it drops down to below 0.02, I buy it back, so I'm out of the trade, so I don't have any risk within the market. So that's kind of how I monitor and determine how I'm going to do my trades based upon support and resistance. And I'll look for weekly here, and I didn't see this stock going in this range for a good number of times. Let me go look at monthly. You go clear back out to here in September of '08, where this stock market was at the highs it's ever been. We're very close to that time frame, and we're due for a pullback in the stock market. So if you look at the volume, of course that's this month right here, the volume is very low. So I would expect to see the volume start to pick up and the market start to roll over. Anyway, that's kind of my analysis of why I put on this option spread, the call option spread, because I do think the market is going to start to run bullish, bearish, not bullish, and or neutral. So this is my option strategy. So if you have any questions, please feel free to comment on this post, and let me know what you think about the option strategy. So this is how to trade options, call spreads, options 101. Good luck trading, and trade with confidence.